Each investment type includes the elements of chance and risk. Chance is the profit on your investment, and risk is the loss of some or all of your investment. There are two types of investments. Passive investment. In investments of this type, the chance is greater than the risk, but the returns will usually be low relative to the investment. Aggressive investment. In investments of this type, the chance is lower than the risk, but the returns will usually be high relative to the investment. Another important way to reduce risk is to distribute your investment over a broad range of trades. Proper rational management of your finances, including a distribution of your investments, will make the difference between a successful investment, which can be managed over time, and a failed investment, which will clear out your investment portfolio in no time. Proper capital management will preserve your capital over time, enable you to trade more calmly, and greatly minimize the damages you incur during losses, which are an inseparable part of trading. Statistics have shown that the maximum loss that an experienced trader can allow himself to lose in a single trade without harming his profit potential is 5% of total capital. An investor who risks, say, 25% of his investment portfolio in a single trade is practically ensuring that he will lose his entire investment portfolio after a short series of losing trades. Series of losing trades is something that happens from time to time to even the most experienced traders. This mistake results from attempting to earn a large amount over a short period of time. Greed is the trader's worst enemy. Proper exposure management can be implemented based on one of two rules. Stable investment with low risks using the strict 5/15ths rule for risk management. 5/15ths refers to the investment percentage in a single trade relative to the investment's percentage out of the entire portfolio. For example, if an investor has a $10,000 account, he can allow himself to risk up to 5%, meaning $500 on any single trade, and up to $1,500 of the entire portfolio. In other words, if the investor risks $500 on a single trade, he can concurrently open a maximum of 2 other trades at an additional risk of 10%. The total risk of all open positions must not exceed 15%. Aggressive trading with high risk. This involves the more permissive 10-30 rule for risk management. The more permissive rule allows the trader to risk up to 10% on each trade with a maximum of 30% of the entire portfolio. This rule is intended for traders who prefer aggressive trades or for traders with small accounts, in order to provide them a certain degree of maneuvering room. For example, if an investor has a $10,000 account, he can risk a maximum of $1,000 on any single trade and up to $3,000 of the entire portfolio. In other words, if the investor risks $1,000 on a single trade, he can open a maximum of 2 other trades concurrently for additional risk of 20%, with the total risk of all trades being no more than 30%. In general, the permissive rule is considered to be the highest level recommended for risk management. It's best to try gradually reducing total exposure down to the stricter level of the 5/15ths rule. The exposure management process leads directly to the next stage, allocation management. In effect, the rules of exposure management dictate to the investor the size of the trades he can open. For example, a passive investor with an account of $10,000 who manages his portfolio according to the 5/15ths rule can risk up to 5% per trade, meaning he will not lose more than $500. If the trader places a stop loss at a distance of 100 pips from his entry point, he can open a trade for $50,000. Similarly, an aggressive investor who uses the permissive 10-30 rule will be able to risk up to 10%, meaning $1,000 per trade, and therefore will be able to open a trade of $100,000. Establishing the risk levels in your portfolio is one of the basic principles of investment management. Over the long term, any investment in an asset involves risk. The use of a stop-loss command is absolutely necessary in order to manage your capital properly. The advantage of the stop-loss command is that it is automatically triggered and is not dependent on the investor's psychological ability to exit losing trades intentionally. The stop-loss takes decisive action for investors who would otherwise tend to pin their hopes on a doomed trade. Therefore, the combination of using technical analysis to determine the appropriate place for the stop loss and the rules of proper financial management are the factors which determine the appropriate size of the trade, thereby neutralizing the psychological influence in determining the size of the trade. The most effective way to manage a stop-loss command is to keep dragging it in the direction of the trend, immediately after a trend progression has been identified. The stop-loss command should be dragged to new points in the open position. In the first stage, try to move the stop-loss to the balance point. From this point onwards, the trade can no longer lose. At this point, you can open another trade, since the risk allocation has opened up. In the second stage, try to move the stop-loss to a profit point, thereby ensuring that the trade will result in a profit. When opening a trade, it's important to define an exit point at which profits will be taken. This can also be performed automatically. Most of the time, profits taken at the exit point will be 2 to 3 times the amount we are risking. In this lesson, we've covered the principles of capital management and how it helps in trading. We've learned how to properly manage our capital by keeping our losses low and our profit potential high. We've learned the 2 main rules of capital management, 5-15 and 10-30. We've learned about the risk levels and ways to work with them. If the material we've covered here is not sufficiently clear, I recommend that you retake the lesson. We will now move on to the next lesson, which is about market analysis. We'll learn how to try to predict which direction the market will move in the future and invest accordingly.